We are live. Welcome to Wall Street Beats, everybody. I'm Steve Lamar, joined today by our oil and gas pro, Bob Morris, and our small cap and value growth pro, Robert Marson. We got the two Roberts on today. Lots of news on the tape this morning with Warsh talking, and we've got IBM says Apocalypse concerned again, and I don't know if those bank earnings look pretty good. And then, of course, we've got Iran back shooting things, which is no surprise. Bob Morris has been warning about that forever. That this thing could reignite in 2.2 seconds, and it has. So, where do you want to start, Bob Morris? Your thoughts on where we're at today?
Yeah, so, we had said last week that when oil was at $70 a barrel, we thought all positive news was in the price and the risk was to the upside. And now the tensions have escalated again. And, we had said we weren't sure what the MOU was going to lead to and that Iran was still playing this stall game. And it appears the IRGC is sort of doing their own thing on the side and, trying to control the Strait of Hormuz and Trump's not messing around. And, sort of FO defense, F around and find out. And that's what they did. And, the news headlines today are the, strikes that they made overnight. And there's another wave of strikes apparently coming. And, the Trump administration is trying to take control of the strait to allow shipments to go through and at the same time reimpose the blockade on Iran exports. And I see no reason why that won't work, but you're not going to get back to 100% movement of shipments through the strait. There's still going to be a slow trickle or flow of shipments through the strait. So
what about this 20% tax that Trump's talking about? Is that?
Yeah, that seems a bit onerous. I mean, if you sort of do the math, that kind of eats into a lot of these shipping companies' profits and doesn't leave much for them to make any money. So I don't know if that's really what it'll end up being or not. Certainly, he's adamant that the U.S. needs to be reimbursed for all the effort and dollars they're putting into keeping the strait open. So that does make sense. Whether it's 20% or some other number, there's some rebate or workaround, I'm not sure. But certainly, he's not going to do anything that stops people from wanting to move cargoes and shipments through the strait. So we'll see how that plays out. It's a tax that people will have to bear, at least for now. But clearly, he's putting a stranglehold on Iran to stop their efforts to control the strait, open it back up, and get oil flows moving. And so oil at around $80 a barrel is probably where we should be right now. Now, does this escalate into a bigger conflict? I don't think Iran has the capability at this point to really fight back in any strong way. Yeah, they have some drones that they can send out, but, the Trump administration is inflicting some pretty severe damage, and to the extent they want to make sure that Iran can't respond, that they have no ability whatsoever militarily of significance to control the strait or do anything to block what he's trying to do. So I would expect that this will succeed. Whether this leads to another, ceasefire or not, and negotiations resuming or not, we'll see. But clearly, I think that the U.S. will be successful in kind of putting this stranglehold on Iran to get things flowing again. So oil at around $80 a barrel is probably where we should be, in the sense that I don't expect a big escalation in the conflict here from where we are. But certainly the U.S. is going to carry out their mission now to, target all these facilities and sites to keep things open and blockade Iran again. So Iranian oil won't flow, but other oil will flow. So I think $80 is about where we should be. It's interesting. If you look at the energy stocks this morning, they're not up huge. They're sort of kind of holding in flattish around here. And I think that's the market saying, okay, we got this little blip here, but, the U.S. is going to get a hold of this and we're going to see flows or shipments continuing. So the market's not looking for oil to spike back to $90 or $100 a barrel. And I think that's where the stocks are sort of flattish here. But I'm not selling anything. We said last week when they pulled back and oil was at 70, some people were asking me, well, do we sell here? What do we do? And I said, no, just hold on. I think the risk is still the upside. And that's what I'm doing still, is just holding on to these names. We're heading into earnings here pretty quickly. The gas names next week and then the oil names after that. But I think you're going to see very positive results out of these companies. I don't think the estimates of the street consensus reflect the extent of the oil price realizations these companies had in the quarter and what they've locked in hedging wise or what they'll realize here going forward. So I think earnings will be very positive and there'll be a lot of beats across the board versus where consensus is now in the energy sector.
Marcin, what were you going to say?
I think the resumption of hostilities is very bullish, Steve. You should. Why is that, Robert? Because now Donald Trump gets to announce another deal for the next 7 consecutive Monday mornings. Pre-market.
We're back in the circle.
He did that in the past, the stock market went up. In fact, they caught him on tape saying, "I don't know, but every time I announce I got a deal, the stock market goes crazy." That's like a paraphrase quote. So he just teed us up for another 2 months of weekly deal announcements.
And he's going to come out and say that they're dying to do a deal. He went and beat him up and bombed him, and now
this is bullish. The stock market did go down when they started, and now he gets to pump the settlement over and over again.
Yeah, at least somebody over there.
The algorithms will bid the shit up out of the futures every Monday morning now.
Yeah, at least somebody in Iran somewhere is dying to do a deal. We don't know who it is, but somebody.
Right. He's got his imaginary deal coming over and over again the next 2 months, fellas. Very bullish.
So where does it stop? 8,000? Where does he stop pumping this thing?
Well, it depends how good the tech earnings are, right? Yeah. IBM pooped the bed. You know, I've been critical of IBM now for 10 years because they were $78 billion in revenue in 2016, and their trailing 4 quarters in revenue is $68 billion in revenue. But by golly, they've made 95% of the quarters. They've beaten 95% of the quarters in the last 10 years. And the idiots don't understand that they sandbag 0% growth, deliver 1.5% growth, and it's a massive beat according to Wall Street, you know, and the talking heads. So
this just a horribly run company at this point, or is this is there some?
I want to say they've done $50 or $60 billion in deals in the last 10 years too, and it hasn't added any value. I mean, well,
is it company specific, or is there some?
I mean, I think, you know, it became a very overrated technology company, got a big premium as a turnaround when they were trying to switch from hardware to software, just as software was in the process of being put out of business by AI, right, in theory. So they kind of have done everything. I think 65%, 70% of the revenues are now in India. Employees are in India. And I think that, you know, it's sort of not a Silicon Valley culture. It was always a big, large bureaucracy, right?
Yeah.
In fact, the guy that invented the hard disk drive, his name was Alan Shugart at IBM. They invented the hard disk drive. And Alan Shugart left IBM to create Seagate. He's the founder of Seagate. And we were drinking one day and at a conference after the conference was over, after dinner. And he said, "I learned one thing at IBM. It was," I complained. I said, "IBM pedigree is crap because the companies, you know, is a big ossified bureaucracy." And he said, "Robert," he said, "I learned how not to manage a company at IBM. Everything about how I run a company today is contrary to how they ran things at IBM. So I think if they were so wrong, I would just do the opposite." And all right, so 1985. So that's how prescient that was, right? Because the stock's done crap for 30 years, and he had that opinion in the 80s.
So, any updates on your names today, Mr. Marcin?
Well, I hope to have some updates on Thursday's show.
Okay.
But I did promise a new name. So you're going to hate me. I
forgot about that.
Yeah, I got a new name.
Well,
so
are you working on it still, or did you?
No. I'm going to share it, even though I've only bought a small amount of my stock. What the hell, you know?
You're gonna let us.
This is and I've had a very mixed record here. This is another small Israeli tech stock. Okay, now everyone's heard of Mossad, right? Their intelligence operation, and they are probably the global standard for efficacy in intelligence gathering, and spying, to call it what it is, right? But there's another elite unit that's focused on signal gathering and electronic intelligence gathering, and it's called the Unit 8200. And a lot of the founders and executives at some of the largest cybersecurity companies in the world come out of this. These are math whizzes in their early teens that are groomed and tested, and since everyone has to do obviously military service there for a stint, they put the best. They teach them to hack and code break and do all this stuff at 15, 16, 17, and you have to be a math genius to be part of this unit. So the founders are from there. A lot of the employees are from this Unit 8200 in the IDF, and they have a global security business, and it's like threat assessment, and it's investigation, and it's fraud, detection, and it's not all cyber, but it's mostly electronic eavesdropping is their primary product. Okay. And they sell it to government agencies around the world. Very, very little of their business is Israel, because it's just a small market, right? A big chunk of their business is Europe and Middle East and Asia. They surprisingly, they call some people call them the Palantir of Israel, but Palantir, was a $400 million business a few years ago, and now it's billions. And this company was a $400 million business a few years ago, and they're still a $400 million business. So they've had lumpy project growth, and then it winds down. So it winds up, winds down, winds up, winds down. They're transitioning the business more to a SaaS model, and they say AI is only increasing the digital and electronic threats out there, and their products are now seeing more demand because of AI. So they're going to do 450 million this year, which is 27 for them because they're a January year, but it's calendar 26, right? And then next year they should do 500 million. The market cap is 650. There's 110 million in net cash and no debt. So that takes them down to 540. So it's really only 1.1 times EV to sales. They have 75% gross margins, and they're supposed to make 70 cents in earnings next year for a $9 stock. The stock's at the low end of the range, and the company is just entering the U.S. market for the first time. And they said they're going to go from nothing last year to 20 million this year in revenue, and more than 20 million in U.S. Revenue next year. So if the U.S. could take off for them, and they sell to states and to agencies and to national, just national government agencies as well as defense agencies, not just the DoD. So we'll see how much traction they can get selling these products. If there's one problem in the income statement, it's in order to support all these different national agencies, they kind of need to spend a lot of money on R&D because they have to sort of get regional expertise,
right,
efficacy, right, and talent. So it's their R&D is 25 to 30% of revenue. So even with 75% gross margins, they're not minting money at 500 million in sales. They do say they do have an operating margin target that's in the 20% range, I believe. So as they grow, they do want to grow their expenses far less than their revenues. Now, 10% growth is still decent compared to a lot of companies if it's compounded. If they can get to 12, 13, if they can get a low teen, I think that people buy is a much sexier growth story. And if they could ever get to 15, it would be much better. So I told the CEO, to the extent he could turn systemic M&A or programmatic M&A of bolt-ons into adding 200, 300, 400 basis points with specific products and body shops, people, talent in different countries, especially the U.S. If there was a small private company that they could buy in the U.S. that had 20 or 30 or 40 million in sales, it would be, an ideal fit to jumpstart their U.S. business. I think that would help the valuation a lot over the next 3 years. So, He took it.
So
under,
do they have a footprint in the U.S. now at all?
they said they had nothing before. This year, they've received their first contracts, and they said they should book and ship close to 20 million in revenues in the U.S. from zero last year, or essentially. Okay. The U.S. is targeted to be their next big growth market over the next 3 to 5 years.
Got it. So, and what's the ticker?
CGNT.
CGNT. All right.
Cognyte, it's called. Cognyte.
And this is sounds like it's a 2 to 3 year. This is a longer term play.
Bumpy. Yeah, especially if they get if AI, the capability that AI creates to create digital and electronic mischief, right? Is a tailwind for them, right? And that's their specialty, not cloak and dagger stuff,
And when is there when do they next report?
Oh, they're a month behind everybody, right?
Okay, so they're going to be,
because they're on a January year, so they're not on a June quarter. It'll be a July quarter, so at least August, at least a full month of August, so early September, I would guess.
Okay.
So, yeah, they're not going to report in the next few weeks like all the June quarters are going to come out.
But, and are you looking for anything in particular in that quarterly number to give you confidence that this is okay? Or
what smashed the stock was their remaining performance obligations took a hit, which is sort of their backlog. You know what I mean?
Yep.
Last quarter, and it was 12 going into the number, and it was 8 and change after a week after the number.
Wow.
So, the stock's down for a reason. I would hope they build their RPO back up. But as I said, they do SaaS business. They also do perpetual license business, which is lumpy business. They still do business the old-fashioned way where they let their customers buy it all up front. And they record the revenue up front. Someone pays them $10 million for licenses. They take that $10 million, yep. And then next quarter they got nothing from that customer, yep. Right? Now you get upgrade service fees and all that. Every few years you get incremental fees to upgrade the technology. So, but it's a small percentage of the purchase price, and I think that's under half of the business, but it's still not insignificant. So that lumpiness is going to be there. So they're still very happy with their forecast, and they did beat and raise a little last quarter or express a high degree of conviction in their double-digit growth outlook for the year. But it's still not as exciting as I would like it to be. And that I think I would be much happier if they were espousing a low to mid-teen revenue range with organic and programmatic M&A.
And how do you enter a position like this, Bob? Is it 0.5% to 1% to start and watch to see the next couple quarters?
Yeah, when it's a starter, or if I could detect positive news coming from a change in management commentary or body language. And that's a lot of what I do. That's my secret sauce. We all have cheap stocks that we look at. The key is to try to get them in front of an inflection point in the fundamentals. That's what made Crocs an interesting buy when it had recovered to north of 100. It's because the body language and commentary from management at their conference presentation turned very positive. I haven't had that with Abercrombie yet. Okay, now I've gotten the first 30% in both of them, so hopefully these won't turn into red trades. I don't think I could lose money fast enough to knock it out. Yeah, but I could if the businesses would ever deteriorate. But Crocs has hinted that the businesses are turning, and Abercrombie hasn't. So I could be sitting on a 1% position, never get any conviction, and decide to sell it. Or if I see them making progress, if they're meeting the numbers, I should make it bigger. If I get the body language of a beat or a beat and raise coming, I would even make it bigger.
Yep. All right. Mr. Morris, anything else you want to follow up on? Yeah, sounds like you're doing nothing with your book, not selling premium into this, just kind of sitting
Just
tight.
kind of watching. I mean, I'm a little nervous about the gas names just because natural gas is not acting well here with where storage levels are and where the fundamentals are for the near term. But I'm sticking with everything right now.
Okay. All right. Anything else you guys want to discuss before we wrap?
I think we're good.
No. Thanks for that new name, Mr. Marson. Thanks for the update on our oil and gas names, Bob. We're sitting tight.
Yep. Watch your Trump tweets.
Watch your Trump tweets. This new war is bullish. Got it.
He's got to give it maybe a week, to let things settle before he starts every week proclaiming the solution is near. So.
Well, I saw he notified Congress. He gave them their notice, so he's got 60 days there. So
it's going to be an interesting technology reporting season, with the memory trade.
For sure.
So
there's
a
lot of expectations built into those.
Yes.
Yeah.
And I could tell you this, to the extent that I don't think we've ever discussed this on the show. I've been buying tech stocks since I bought Seagate in 1982. It's the first stock when I was a rookie retail broker at Smith Barney. So that dates how long I've been buying tech stocks. And I followed the hard drive business since then. And I with my experience and understanding of the business, I do not know what level of incremental secular demand AI has created and where memory and DRAM, whether memory and storage pricing will settle for the next 2 or 3 years. It could be that it's a blow off top and it's triple ordering right now. And it could be that we get to a plateau that lasts for 3 years because the industry is chronically short supply for 3 years. Yeah. And anybody tells you they know on Bloomberg or CNBC has no clue. If they're 100% short of their position, either bullish or bearish, they're wrong.
Well, I've heard a lot of chatter about this. The ROI isn't there for the user.
That's AI in general. Yes. Yeah. Well,
you think you're getting all this great efficiency?
You've been hearing, you've been hearing that from me for a year. So I don't know what to tell you. It's the business. Never has so much money been invested on a business model that once you remove the subsidies is unprofitable. Because the demand when it was infinite, compute demand, it was because the service was free.
Right.
Meaning so heavily subsidized, it's essentially free. But now that you have to pay for it, people are shocked at what it costs. So when something's free, of course you'll abuse its consumption. It's freaking free. But when you have to pay real money for it, and companies are blowing through their AI token budget in 4 months for the year, then managements and people are going to say, whoa, I'll use all the free services I can get. Once they want me to start paying $20 a month, I go to the next free one.
Or I'll build my own local one.
There you go. So we know you are 100% right. Nobody has a clue about the ROI on the business, and it's very surprising, that the build out commitments have been so massive despite that. And that tells you there's a few big monopolies that need this to be the next big thing and or feel, it's existential to them to have this capability. But Facebook's announcement that they're going to rent excess compute is not a positive sign for the efficacy of their AI product, because that's going to be a commodity business. It's going to be a capital intensive, high operating cost commodity business, in my opinion. It's going to be an equipment leasing business, something like that.
Yeah. And we've got a couple more giant IPOs to come out with Anthropic and OpenAI.
Yeah. The poop's going to hit the fan here. There's going to be a massive problem with the AI data center build out. But a lot of this stuff's being postponed anyway, naturally, from lack of power and lack of approvals, lack of zoning, all that, neighborhood resistance.
People don't want it in their backyard.
No, it is. I already said this over a year ago. It's going to extend the cycle, but take reduce the growth rate quite a bit. So I don't know if that's good or bad for the stocks, by the way. Saying that it's going to be, pushed out and more, thoughtfully developed. I don't know that that this thing can't exist another year, another 2 years. I don't know that. So Silicon Motion and Intest, they're my AI.
Got them on a tight leash.
They're my AI hedges. Meaning I'm kind of short AI, so I got to have something that goes up if I'm wrong on the implosion of AI.
Got it.
They're my only 2 long trades for AI, and all my other semiconductors and power stocks have been sold into the rally. So but I still don't want to go 100% naked. So it's like if you're bearish on the stock market, you have to have 2 stocks that work if the bull market continues. This is that version of my, my natural inclination to doubt this whole data center build out thing, but I still have to have something that works if it continues.
Yep. All right, let's wrap it up there. You got a All-Star game in Philly, I hear. You going to that?
No.
All right, then we'll be
I'll watch
soccer here.
I'll watch it on TV like the rest of America.
All right, gentlemen. Thank you. Thanks for following us on Wall Street Beats, and we'll be back here tomorrow.